So we talked about bonds last time and how they're one of the sources of debt that companies take. And essentially, what's happening is the company is selling a bond to an investor. So the two parties involved in this transaction is going to be the corporation that's trying to raise some debt and the investor that is actually loaning the money to the corporation. And the way they're going to do that is they're going to buy a bond. So the investor is going to give cash to the company, and this is their way of loaning the money to the company. And the bond that they're purchasing is actually an agreement. Okay, so it's an agreement to repay both the principal that they borrowed and also the interest that they're going to agree upon. And this will be done over whatever the fixed term of that bond is. So just very similar to what a bank loan would be, except this is to an actual investor. So these bonds are generally sold in blocks of $1,000 each, so it can make it affordable for the average person to buy it. So the investors can be individual people or pension funds, but basically, if you want to invest $100,000 in bonds, you would buy 100 blocks of or 100 bonds that are worth $1,000 each. So let's go over a couple of the key terms that are associated with the bond, and I'm just going to do a sample bond issue here. I'm going to say the issue amount of 20 million is what the company is trying to raise. So the company's decided that they want to take on debt of $20 million, and they're going to raise that by issuing their bonds. So that would be written out in the terms of the bond issue. Now, the next thing is the issue date. So this will be the date that the bonds are actually sold on the market, and the company will receive money on that date. So we're going to assume, for the sake of argument, that this is, in our example, January 1st, 2020. Okay, so that's the date they raised the money. And the maturity date is the date that they're going to repay the money. So the repayment of the loan, the principal is done. So instead of December 31st, 2020, let's just make it January 1st, 2030. We'll make it nice and clean. So it'll be 10 years down the road. And on this date, the full principal of that bond is going to be repaid. And they'll be paying interest throughout the bond. Okay, now that's where it's a little bit different than a mortgage. A mortgage, when you take on a house, you generally pay both the interest and principal throughout the life of it. In the case of corporate bonds, usually the principal is paid at the very end, and you only pay interest in the meanwhile. Face value, like we said before, we'll treat it as $1,000. Most bonds tend to be in $1,000 increments, and this would be the value of each bond that you're buying. Coupon rate is the interest rate that they pay. So if we assume 3.5% annual interest, that is the annual rate of interest that you're going to earn. It doesn't mean necessarily that it'll be paid once a year or annually, but it equates to that. In this case, we're going to assume it's paid every 6 months. So coupon dates tell you when it's paid. So January 1st and July 1st is when it'd be paid on a semi-annual basis. And that's probably the most common type of bond that there is. Normally, bonds will pay interest every 6 months. Yield, I'll just leave it at 3.5% for now. This is really the current rate of interest on similar bonds. So at the time that it's issued, it's the same thing. We'll talk a little bit more about this in a later tutorial and see how it comes into play on bond pricing. But for the time being, we'll just leave it as one of the terms. And the rating of this bond is a AA, which we'll talk about in the next video as well. That's a very good rating. It's just like a credit rating that an individual would have. The higher the credit rating, the more the likelihood that you are able to repay it, and the more attractive the bond becomes. So this is a 10-year bond, essentially. Interest will be paid every 6 months, and the full amount of the loan or the bond will be paid at the very end. The $1,000 that you borrowed will not be paid until 10 years down the road. And again, that's why it's very different than a typical mortgage or a loan, and that's the way bonds are generally set out.